Thanks for watching this Magellan update. We're doing it exclusively for the clients and investors of Benchmark Financial Services. Magellan now manages over $60 billion of funds on behalf of investors just like you and institutions all over the world. And today I'm speaking with Hamish Douglas, the co-founder and portfolio manager for the global strategy. Hamish, what is some of the key holdings in the strategy and why are you holding them?
Yeah, well, if I start our two largest holdings, both Alphabet and Facebook. What are these? These are digital advertising platform companies. They're taking around 80% of all incremental advertising expenditure outside of China in the world. And why are they so powerful? They're so powerful because of the data that they collect on their users. They don't share that with their advertisers, despite what you may have read in the media, and they can then target the ads very, very specifically, either on a social platform, in a search platform, depending which entity, and they're enormously beneficial from that. But they're still early days in terms of their total penetration of the global advertising market. The television advertising complex hasn't yet fallen. It's probably around $200 billion worth of advertising revenue, and we would expect, as we move to more consumable video content outside traditional pay television and television industries of the world, a vast majority of that revenue will go to new digital video advertising platforms. YouTube is probably the most well positioned of that, and that is obviously owned by Google, but also Facebook is investing very, very deeply in video formats, both on Instagram and on the core Facebook platform. So we think they're still early days in monetization. Google's growing its revenues around 20 to 25% a year, and Facebook's growing its revenues around 40 to 45% a year at the moment. These are some of the most powerful businesses that have been formed in the last 100 years. And still they are fundamentally cheap in our point of view. The Google business is potentially even more interesting because they've got a whole series of other businesses that haven't yet been monetized. If you believe in driverless cars, they've got a business called Waymo, which I kind of think may stand for way more miles or something like that. They have never said why they called it Waymo. They are so far ahead in the driverless car technology. They will be rolling out the end of this year, open to the public in Phoenix in Arizona, a car hailing service that will look a little bit like Uber, but when you call it up on the Waymo app, it'll be a fully driverless car that comes. And they're looking to roll out in the United States, maybe over the next 3 years, maybe 60,000 driverless cars. That is going to be a massive business for Google in the future. And of course, they've got a very large cloud computing hosting business in the world, which is a sort of another theme in our portfolio. We own 2 of the 3 hyperscale cloud hosting platforms in the world. One is owned by Google, one is owned by Microsoft that has been a long-term holding called Azure, and the other one is owned by Amazon called Amazon Web Services. We don't own a position in Amazon, but we own 2 of the 3 big cloud hosting platform businesses in the world. So our 2 top businesses are advertising platforms of the world, and we think they're fabulously well positioned for the future.
And so, Hamish, how does the fund aim to preserve capital when markets are volatile?
Yeah, our first standpoint is we actually build our portfolio, we construct it in a certain way. We've actually got 2 portfolios inside the global equity strategy. One portfolio plus our cash is a very defensive, resilient portfolio of businesses that don't have a lot of economic sensitivity. Historically, we've owned a lot of consumer staples, businesses like Nestle and Procter & Gamble and Coca-Cola. We don't own as much of that today because of rising interest rates, and many of those businesses, some of their brands are starting to be disrupted in the world, but we own other defensive businesses like quick service restaurant companies in the world. McDonald's and Yum Brands have been very long-term holdings, and we've recently gone into Starbucks. And I joke to people internally, I don't think we're about to start drinking a virtual coffee in the next 20 years. And they're fabulously well positioned in China. Starbucks, like Yum Brands has been for a very long period of time. But we also own businesses like telecommunications infrastructure. So the towers in which all these telecommunications for mobile networks is based, we own a large business called Crown Castle, which is one of the two very large providers in the United States. And its infrastructure, very, very secure, long-term contracts that escalate above CPI in the long term. So that's our defensive portfolio. And if stock markets shake, that and whatever cash we hold tends to be very resilient against a big market downturn. And then the other side of our portfolio is where you find more of our technology and financials and consumer cyclicals that have some higher risk but have higher return potential. And when we bring those portfolios together, we have a portfolio that has much lower risk characteristics than the overall market. We actually cap something we call a combined risk ratio, which is a combination of the volatility of the companies plus their experience during market downturns in the past, and we cap that at 80% of what the market's combined risk ratio is, which of course is 1 in the market aggregate. And then from time to time around our reading on macro risk, we may dial up the defensiveness of the portfolio and hold some more cash like we are at the moment. And actually over the history of the fund, in any 3-month period where the markets have had a negative return, we've had 50% of the downside of the markets, and we've actually captured 100% of the 3 months where the markets have gone up. I can't promise we're going to get exactly those statistics, but I think we do a lot of risk management that gives us a lot of resilience if something goes wrong in stock markets.
So Hamish, what are your thoughts on markets and the macro outlook?
First of all, I'd say we're very cautious at the moment, Frank. We have now got 18% cash in the portfolio, and I would argue we've probably got one of the most defensive portfolios we've had since 2009. So that's saying something about how cautious we may be. I've written that I think there is a very elevated probability, that doesn't mean it will happen, that we could have a 20 to 30% market correction in the next 12 to 18 months. And that's because we've got an extraordinary bringing together of circumstance at the moment. Equity markets and many asset prices around the world are at or near their all-time record levels. We've got the major central banks, the European Central Bank and the US Federal Reserve, who are in a process over the next 6 months, and they started 6 months ago, of withdrawing around $1.5 trillion in US dollars of liquidity out of markets. So the central banks are going to be far less supportive of asset prices than they've been through this period since the financial crisis. We have the United States economy that's absolutely humming at the moment. Unemployment's at an 18-year low, 3.8%, and the Trump administration is adding at the end of this long expansion a very large fiscal stimulus with large tax cuts and actually an increase in expenditure in the economy worth about 2% of GDP over the next 2 years. There is a chance that we could effectively have a major bond market correction if the Federal Reserve gets behind its tightening curve, tightening monetary policy, and wages in particular start accelerating, causing inflation faster than anyone's expecting. And this cocktail of stimulus adds to that risk. If that happens, I don't think it's inconceivable that we could have a rapid and sudden, quite sharp market correction. Do I say that's going to happen? I have no idea whether it will happen or it won't happen, but I do think the risks are very elevated compared to the periods we've been in for many years because of these circumstances coming together. And of course we've got the uncertainty with the trade situation with the United States and many of its partners. The market isn't pricing an all-out trade war, particularly with China. But again, it's not inconceivable that this thing could get a lot uglier, and it's just not going to be settled with a deal by Trump and China in the short term. So there's a series of reasons why we're cautious at the moment and why we're holding near our maximum cash levels at the present time.
Thanks, Hamish.
Pleasure, Frank.
And thanks for watching. Benchmark have been a long-term supporter of Magellan, the global fund, for many years, which we appreciate. If there is further follow-up advice as a result of this video, feel free to make contact with David or Rosanne at Benchmark. Thank you.